Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey.
Sam, it's 10 a.m. Pacific here on December 6th. The end of the year, holiday season's approaching. I have not done any decorating, so I think that's going to be my plan for this weekend.
Yeah, I did some, I got the Christmas tree up. I've got some lights around it, some presents underneath it. I've got some outdoor lighting up. It looks pretty jank, but outside. But I've already had some neighbors comment on how facetiously how good of a job I did. I'm trying.
All right. Hey, all we can ask is you try. Why don't you try to educate our listeners on where we are? Where are we for the week?
All right. So for this week in markets, looking pretty good, and at least in the traditional asset classes here. S&P 500 up 90 basis points week to date. Just crushing it year to date. It's just up just over 29% thus far on this early record for the year to date return. But looking across what we've done on the week to date basis, we've got three sectors in the green right now. Leading the way is consumer discretionary, up over 4%. Technology up over 3%, comm services up about 3%, or no, sorry, it's 2.5% for comm services. So the three sectors that hold a lot of the Mag 7 names are up bigly on the week to date basis. Consumer staples is kind of flattish right now. It's just I guess we'll count it negative. It's down about 20 basis points, but everything else in the red here. Leading the way down are some of the smaller sectors by market cap. Energy down 4.5%, utilities down 4%, and then real estate down 3%. So all in all, when you take a look at the headline numbers, it looks pretty good, but pretty narrow breadth when at least when it comes to looking at the sectors. I didn't take a look at it on name by name basis today, but from the sector level, we just got three firmly in the positive, leading the positive week for the S&P 500. But on the year, going back to that year-to-date basis, a clean sweep, as we talked about the last few weeks as well. Everything is in the green this week. The worst performer right now is healthcare, up only 7%. The best performer is, let's see here, comm services leading the way now, up just over 40% on a year-to-date basis. The previous winner, the pack leader, was utilities. Right now, that's up just shy of 30% on the year-to-date basis. Moving over to fixed income, starting with Treasury land. Let's see here. Pretty much looks like the 2-year Treasury note is 5 basis points lower on the yield. That's sitting at a yield of 4.1%. All of that move took place today after some of the economic data that came out, so we'll get to that shortly. But across the rest of the curve here, the 10-year note pretty much flat on the week, sitting at 4.16 yield, and then the bond pretty much flat as well, with a yield of 4.34%. So what did that mean this week for the broad bond complex? As measured by the Bloomberg U.S. bond aggregate, that's up 30 basis points on the week-to-date basis. That's a little bit redundant there, but looking across the sectors here, a clean sweep on the week-to-date. Bank loans, the laggard, up 10 basis points. Let's see, we've got the best performer here is going to be EM sovereign debt. That's up 70 basis points. Everything else that we talk about here is right around 30 basis points positive for the week-to-date basis. And similar to what we saw with the year-to-date look on the S&P 500 sectors, it's a clean sweep as well for the bond cohort that we look at here, with everything in the green. Leading the way is high-yield corporate credit and EM sovereign debt. They're pretty much neck and neck. They're up about 9% or so on the year so far. The laggard right now, albeit of a positive print, is the U.S. Treasury market, up 2.5%. So when looking at the broad, again, the ag as the complex, that's up about 3.5% for the year to date. Moving over to commodities, pretty much a similar look. Commodities keeping a similar pace on the year-to-date basis. That's up about just over 3.5% as well for the year-to-date. But on the week-to-date basis, that's down 50 basis points. Both WTI front-month futures are negative this week, as gold front-month futures. Both of them down about 70 basis points on the week-to-date basis. WTI crude front-month futures right now are below 70 as they were in the past week or so. They are sitting right now at $67.50 a barrel of WTI crude, and gold is at $2,640 a troy ounce. So with that wrap up of the market this week, Jeff, can you kick us off on what happened on the macro front?
Yeah, sure, Sam. You did forget to mention your favorite asset, though. Bitcoin up over 100,000. I was just pulling it up on Bloomberg, looking at the chart, and instead of 100,000 is now 0.1. So they changed the scale of it because it passed that 100,000 mark. It'll be interesting. Yeah.
I did see an analyst, taking advantage of some of this that breakthrough of the 100,000 mark and saying that he expects to see it at 200,000 now. It's not inconceivable to see it by late 2025. So wait for Jason Ferrant, which this is his favorite asset class there.
Well, it's up 140% year to date, so you just need that again to get that 200.
That's right.
And change. All right. We have a busy macro week or week and a half since we didn't do one last week. We didn't do a podcast last week, so I'll cover quickly the few data points we did get before Thanksgiving. On Tuesday, November 26th, we got the S&P CoreLogic Case-Shiller 20 City Home Price Index. That number came in at 0.18%, that annualized number of 4.6. So kind of a little bit more normalization, a little bit kind of more, quote unquote, normal numbers there from the house price index. Also, we got the GDP number on Wednesday for the third quarter. The second estimate for the third quarter came in at 2.8%, right on the nose or unchanged from the previous estimate. So no real big change there. And then we got the personal income and personal spending on Wednesday, the 27th. Personal income came in at 0.6%, up from the 0.3 estimate, and personal spending came in at 0.4, right on the screws there from that estimate. Nothing really stood out there. Those numbers have been a little bit volatile, kind of around the same kind of level, but so nothing really to talk about there. And then we got the Fed's preferred inflation gauge, the PCE price indices came out also on Wednesday, the 27th, before Thanksgiving. The month-over-month headline PCE came in at 0.2%. Core PCE came in at 0.3. That brought the core PCE over here to 2.8. That was right in line with estimates. So no big surprises there. I think by the time the PCE comes out, everyone kind of knows what it's going to be. So really that 2.8 though, that's not really hidden. It's up from 2.7 last month. So trend is not your friend here if you're the Fed. But it also seems like we got a long way to go before we get to that 2.0 from the core PCE. Then this week, another busy data week. We did get on Monday the ISM manufacturing number that came in at 48.4. That was up 0.9 from the 47.5 estimate. Was 46.5. So still contractionary, but getting closer to that 50 break-even number for manufacturing. So interesting to see whether that trend continues. On Tuesday, we got the JOLTS job openings data that came in at 7.74 million. Estimate was 7.52. So a little bit higher than expectations. And I guess the prior revision was kind of the same. So not really, it was kind of a decent bounce. We're still at the 1.1 in terms of the job openings to unemployed number of people. And I guess that's good when you look at that chart. It kind of has bounced around this like 1.1, 1.08 last month. So it's bounced around this level. So we're not going through, the trajectory was so bad. You could be like, oh my gosh, there's going to be no job openings. There's going to be all these unemployed people. The ratio is going to collapse. The Fed has engineered a recession. From here, it looks like maybe the Fed is going to be able to engineer the soft landing or a no landing scenario because this ratio has kind of leveled out here at this 1.1 level. We also got ISM services number came out on Wednesday. They came at 52.5 or 52.1. Sorry, I was expected to be 55.7, so well below estimates there. Still expansionary, so that's good. But it's pulled back from it was a 56 in October, and really it's kind of dialed his number back. Still expansionary, but maybe showing a little bit of a slowdown there in the services side of things. We also got the jobless claims yesterday. Initial jobless claims came in at 224,000. That was 9,000 over the 215,000 estimate. Continuing claims came at 1.87 million, below the 1.904 estimate there. So they're kind of a mixed bag there, but they are not really moving, or they're kind of bouncing around these levels. So really nothing to see here. We'll kind of see whether there's a breakout one way or the other on these jobless claims numbers. And then everyone was waiting for the big day today. On Pizza Friday, Jobs Friday, we did get the change in the non-farm payroll numbers. Remember, last month was a very weak month. Everyone was assuming that it was because of the hurricanes that were hitting. We got a 36,000 job month last month. That got revised up by 56,000 over the last 2 months. Sorry, the 2-month revision was up 56,000. We got the 227,000 for this month. For November, the estimate was 220. So pretty much right on the estimate there. Nothing really to see there. You did see the unemployment rate ticked up from, it was expected to be 4.1. It ticked up to 4.2, but kind of flat. So nothing really to see there either. It was almost on the round. The labor force participation went from 62.6 to 62.5. Maybe if you kind of squint, you could see a little bit of a slowing in the job market, but nothing really to get worried about there from the Fed's point of view. And so really you didn't see a pretty muted market reaction today on the jobs numbers. Nothing really moving around. I see the 10 years up two ticks and the 2 years up 2 ticks. So not much movement there. I guess the one thing that maybe to be worried about is the University of Michigan inflation expectations number came out at 3.1. So it's still hanging around there at that 3.1 level. Hasn't come back down to kind of below 3. We're not really unanchored, but it's kind of at this more elevated level. So really, a pretty busy week. We got that jobs number out. We get CPI next week, and then we get the Fed. So this is one of the two kind of big data points before the Fed really can feel like, or until we can feel much more confident on what the Fed is going to do on December 18th.
Yeah, it's closing that gap pretty quickly, just less than 2 weeks. So we'll see.
Yep.
Maybe some sneak peek at data next week, but outside of that, it seems pretty good, at least with the data set that we got this week.
Yeah, and the WERP function shows a 90% probability of a Fed rate cut now on December 18th. There was a lot of Fed speak this past week, but really nothing that stood out to me. It was more like some people were saying that we're going to continue the process, do it more gradually. Even Powell spoke and really didn't move markets much at all. So really we're kind of steady as she goes here from the Fed side of things. Kind of wait and see. It's interesting though. We only have between now and the end of next year 3.5 cuts priced in. So if we get one here in a couple of weeks, then there's only 2.5 cuts priced in 2025. So the market's kind of saying, if you kind of take it at face value, that maybe inflation is going to stay a little bit hotter than the Fed was expecting, and they're going to get less rate cuts in 2025 as they try to keep inflation under control.
Yeah, so a little bit undershooting what if memory serves, what the Fed had projected in their September SEP for 2025 of 100 basis points of cuts in that year. So just a little bit off from there, and we'll see. There's a lot of time in between there, so we'll see
That's right.
which one comes out right and what the SEP comes out to look like in 12 days here. But in terms of things to keep an eye out for next week, we've got inflation week jumping off here with CPI coming out on Wednesday. That's expected to be largely in line with what we saw the previous month. So for the month of November on the year-over-year basis, it's expected to be at 2.7. That's a 0.1% higher than the month of October. For the year-over-year on core, it's expected to be at 3.3, in line with what we saw the previous month there. And then finally, we'll also get the PPI data on the following day on Thursday. That's expected to be largely just a little bit of acceleration, I suppose, on the month-over-month basis. 0.3 on the headline, which is 0.1% higher than the previous month. And then on core PPI, that's expected to be 0.2%, deceleration there for the core side, expected to come in at negative 0.1%, lower than the month of October. And then on Thursday, if memory serves there, or actually, no, it's on Friday, we'll also have the import and export data coming out for that month. And then for longer term listeners of DoubleLine minutes here, they know that we do like to look at that number as well, because that is more of an unadjusted look on what might be expected in terms of price inflation or deflation that's unadjusted there. And we don't really get a survey number on that, but we'll wait for the following Friday to see what that data looks like. So those are pretty much for next week. I think the CPI will be the big hitter in terms of the last major data point that the Fed will have in their belt for their FOMC meeting in December 18th.
Yeah, that sounds about right, Sam. And I think it seems like things are starting to quiet down a little bit. It's not as frantic as people start to kind of set things up to go into the end of the year.
Yeah, we're getting to be a little bit. It's going to start getting much slower there on the desk as people wind it out for the holidays there.
That's right. All right. Well, I think that wraps it up for this week, Sam. I'd like to thank everyone for listening.
Yeah, as always, thanks everyone for checking us out there on the minutes today, be it on the X through Spaces or the recorded version, or even on your old favorite platforms for podcasts. Jason Ferrant likes us to remind everyone that we also have the audio version of the podcast, along with the visual side of charts on our YouTube channel as well. So you can check us out there. In the meantime, if you have any suggestions for the topic of the week type section that we have here on Minutes, you can send it to us via email at minutes@doubleline.com or via the X at DLine Minutes.
Yeah, and our YouTube channel is youtube.com/DoubleLine Capital. We did post the most recent episode of Channel 11 titled I Shot the Tariff, going over the kind of markets from November. It's a pretty short one. I think it's like 12 minutes. I watched that this morning. So that's about it, though, on the YouTube side. Make sure to check us out there also. So I'd like to thank everyone for tuning in and hope everyone has a great weekend.
All right. Thanks, everyone, and good luck out there.